Welcome back. The S&P Muni Bond Index has been outperforming the 10-year since the election. 10-year yield touching its lowest level since October earlier. But the incoming Trump administration and the expiration potentially of Trump's 1.0 tax cuts could bring some noise and headlines to the muni market, according to my next guest, including questions about the tax-exempt status. Joining me now is Nisha Patel, Director of Fixed Income Portfolio Management at Parametric. I mean, Nisha, you went there. Tell me what you're hearing, what people are talking about.
Yes. So I don't think it's going to be a big surprise that, 2025 could be just a big year of taxes and talking about tax policies. The implementation itself, however, could take some time. In what form that comes in, it's unknown. Something that has been thrown around quite a few times, as there are a lot of pay-fors that are being considered, is the tax exemption of municipal bonds. And the only reason I bring it up is because,
well, it's the main reason to bring it up.
Yes,
if that were even on the table, it changes the entire attractiveness of the asset class.
Market. Yes, and it would destroy the market, right? So, I mean, you have a $4 trillion market, all these municipalities. How do they finance all these projects, especially when both sides of the parties agree that infrastructure projects are needed? It would be catastrophic. So in our view, the risk is going to be very low to the actual elimination across the board. Now, what could happen is that certain sectors could be targeted, right? So you have non-for-profit private colleges, large colleges with endowment funds that do issue through the municipal bond market. Now, on one hand, again, you make up, it's a small drop in the bucket. If you count kind of the actual revenues that are going to be raised relative to the amount that the deficit.
Yeah.
But perhaps that's the approach. Exactly. You're lifting all mattresses. You're looking everywhere possible.
Or if you're looking for an opportunity, I don't want to say to punish, but like to take, a perceived nemesis, which might be certain private colleges, and say, okay, well, your time's up. So, talk about you'd see immediately, I would imagine, a backup in yields because they would have to get more. Now, but I think about the investors in muni asset classes, and some of these tax equivalent yields lately have been upwards of 7%, right?
Yes.
But you're not drawing in the kind of investors who really want 7% yields. You tend to draw in conservative investors. So on some level, maybe if the tax equivalent yields were only 5, they might still be in the asset class. I don't know.
Yeah, I mean, look, I would say I still go back to the tax exemption across the board, in our view, is a very, very low threat, right? Just because even if you were to tax the entire municipal bond market, that is going to not be anywhere close to the amount of additional costs municipalities would have to pay in higher financing costs over time for all these projects that are needed across the country. To your point, I mean, look, what would happen is in those subsectors, like we talked about the non-for-profit, you could have yields certainly go up pretty high. In which case, if it is going to be fully taxable, you could have your non-traditional muni buyers come in to buy that type of debt,
right,
but you still have the other sectors that are available. Now, you brought up tax equivalent yields. I think my main point today also is just, look, this has been, and I think last time we talked about, it was an opportunity then. It's been a bumpy ride for bond investors. I'm not going to sugarcoat that, as we all know.
Yeah.
Yields are higher this year. Look, we see that in treasuries. We see that in munis. We've seen a good performance in month of November so far this year. We have a positive return on the index. Let's hope we close it out that way this year. But absolute yields are high, and I think that's the exciting news for bond investors. So if you are in a high tax bracket, which for the foreseeable future is not going to change,
totally,
you're looking at tax equivalent yields anywhere from 5 to 6%, and you do not have to take on a lot of duration for that either.
This makes my brain hurt to think about, but like if SALT changes, is that going to change a potential class of investors who would have less urgency to seek out munis or anything like that?
It would make, so if the cap is eliminated, it would make munis, let's say, less appealing, particularly for the in-state, right? So you could go then out of state and buy that. So overall, you would say, high level, you could see the demand for munis coming down. However, the current administration is even talking about lowering the cap, in which case you can have demand for munis go up, especially in-state, right? That 10,000 actually being lowered. So again, that is also another element there. So there are a lot of elements on the tax side that certainly can affect the market. And I think the last point I'll make is that a lot of just the talking about, a lot of the rhetoric, the media publication of this it's going to create pockets of weakness. And I think that's an opportunity.
Indeed.
Right. And even so for managers that take advantage of it, it's great.
Absolutely. And just to know that changes could be coming is often a catalyst to say, okay, let's look at what we can do now while it's still the case. Nisha, thanks. As always, good to see you.
Thank you, Kelly.
Nisha Patel.
Yes.
That closes us out today for the exchange. I'll see you on the other side of this break, though, for Power Lunch. Don't go anywhere.
Muni Money is sponsored by BAM. Help build America's future with BAM-insured Muni bonds.
Infrastructure makes our economy grow and keeps our communities strong. And now's the time to build. BAM Mutual protects municipal bond investments that finance essential projects, providing an added layer of security to improve your portfolio with guaranteed income that helps investors reach their goals. Invest with confidence. Build a better portfolio with BAM-insured bonds.